Friends, how are you? Welcome to Easy Learning Economics. Today we are going to discuss the types of revenue. This is a very important topic. In this lecture we will study that what is revenue, what is total revenue and elasticity of demand, what is operating and non-operating revenue, what is front end, back end revenue, what is marginal revenue, what is average revenue, what is rent revenue, what is dividend revenue, what is interest revenue. So these are the different types of revenue which we study in this lecture. You can get my notes on economic related topics on this website. The link is given in description box, that easylearningeconomics.blogspot.com. So here first of all we start with that what is revenue. So the revenue is the gross income received by the seller against the sale of goods or services. It is not the net income, but it is a gross income. Remember, the revenue can be explained as the quantity into price. Revenue is the gross income a company generates before any expenses are subtracted from the calculation. Revenue does not show that how much your business has gained or lost, but gain or loss is calculated using profit. So to calculate profit, revenue is the starting point. Revenue increases with credit entry and decreases with debit entry. Revenue target for the government is the income tax revenue, custom collections, sales tax and the federal excise duty. These are the different revenue targets on the part of the government. What is total revenue and elasticity of demand? Total revenue is the amount through the sale of all output. Total revenue shows the flow of income to a firm for selling a given quantity. Total revenue we can explain as the average revenue multiplied by the total output. You can see here in the table that the price is 1, 2, 3, 4, 5, 6 pounds and the demand is 6, 5, 4, 3, 2, 1, 0. The total revenue means price into quantity demanded. When total revenue increases, the price elasticity of demand is greater than 1. When total revenue remains same with change in price, so the elasticity of demand is equal to 1. When total revenue decreases with change in price, it means the elasticity of demand is less than 1. In this table, that the total revenue increases from 5 to 8. It means at this point the elasticity is greater than 1. When the price is 2, the quantity demanded is 4 and total revenue is 8. When price increases from 2 to 4, quantity demanded decreases from 4 to 2 and the total revenue remains same, that is 8. It means at this point the elasticity of demand is equal to 1. When the price increases from 4 to 5, the quantity demanded decreases from 2 to 1, but the revenue decreases. It means at this point the elasticity is less than 1. So you can see here that the elasticity is equal to 1, elasticity is greater than 1 and elasticity is less than 1. So what is operating and non-operating revenue? Operating revenue means the amount you receive from business main activities and it is recorded in the sales account, like revenue from sale or commission from sale and purchase of the properties. It helps to measure the company progress. Operating revenue define the company progress, while non-operating revenue is irrelevant towards the company performance. So what is non-operating revenue? So non-operating revenue means money income that is earned from side activities that are not related to your business or day-to-day activities, like dividend income, profit from investments. Non-operating revenue ratio we can calculate here. Non-operating revenue ratio is equal to non-operating revenue divided by the total operating revenue. So the non-operating revenues may include interest income, dividends, gains from investment activities, and assets released from the restricted investment accounts. So what is front end and back end revenue? So the front end revenue is the revenue which is generated from the new customers, and back end revenue is the revenue or the amount received from existing customers through the sale of services or goods. What is marginal revenue? As we know that the marginal means change or additional. So the marginal revenue is a change in total revenue per unit change in sale, and it is equal to the slope of the total revenue. The formula for the marginal revenue is equal to change in total revenue divided by the change in quantity sold. This table will be helpful to understand the marginal revenue. As you can see here, when the quantity is 1, the price is 10 and total revenue is 10. As the price decreases from 10 to 9.5, the total revenue is 19 and the marginal revenue is 9. So the marginal revenue means the change in total revenue. So the total revenue has been changed by the 9 rupees with sale of one additional unit of output. It means that the total present revenue is 19 minus 10 is equal to 9. So marginal revenue means the change in total revenue divided by the change in quantity, where delta represents the change. So remember, when total revenue is maximum, marginal revenue is not at its maximum. You can see here, when total revenue is maximum, marginal revenue is not at its maximum point. Rather, marginal revenue is 0 when total revenue reaches its maximum. When total revenue is maximum, marginal revenue is 0. This is due to the fact that when marginal revenue is 0, it implies that there is no addition to the total revenue. That is, total revenue becomes constant at this point. So what is average revenue? Average means per unit revenue, or it is also called the price per unit, or the demand curve is the other name that is given to the average revenue curve. Average revenue curve is often called the demand curve due to its representation of the product demand in the market. Average revenue can be calculated that the total revenue divided by the total quantity. So here you can see in the table that how average revenue is calculated is when the price is 10, the quantity demanded is 1 and total revenue is 10. So when the total revenue is 27 divided by 3, that the average revenue is 9. When the total revenue is 34, the quantity demanded is 4, that the average revenue is 8.5. So it means that average revenue means the total revenue divided by the total output or total quantity. What is rent revenue? The revenue which you receive from your building that you have given on rent is called the rent revenue. So rent revenue may be earned or unearned. Unearned rent revenue, it means that is the revenue or rent received in advance which has not been earned. Whereas the earned rent revenue, it means the revenue received after the use of the buildings that you have given on rent. When unearned revenue is received, the cash is debited, unearned revenue is credited. When the unearned revenue is earned, we make an entry that unearned revenue debit and the revenue is the credit. So these are the entries which we make against the unearned and earned revenue in the accounts. So what is dividend revenue? If your business owns stock in other company, then you are paid dividends, or it is an other non-operating revenue. So what is interest revenue? Money income earned through investment made in another company is interest revenue. That is also non-operating revenue. net interest margin, we can calculate that the interest revenue minus interest expenses divided by the average earning assets. So I hope that all the types of revenue would be clear to all of you. In the next lecture we will discuss that what is the shape of such revenue curves and how the revenue is under the perfect computation, imperfect computation. In the next video we will analyze the revenue and their shapes and their relationship. So if you have any feedback or any future request, you may comment in comment box. I hope that you like this video and make sure that you have subscribed my channel. So if you have not subscribed my channel, you must subscribe, because you will get the more information from my side on the range of the micro and macro and managerial economics, so on so in the future. So don't miss to subscribe. Thank you very much for watching.